of Consultant Relations at Fidelity, working across our wholesale clients and private wealth clients. And it's my pleasure today to be stepping in for Lucas de Pulbe as host of this podcast. And it's my pleasure to be welcoming Amit Goel to this session. Amit, of course, is a portfolio manager of Fidelity Global Emerging Markets and also Fidelity India, and lots of interesting discussion points to go through today. So welcome back to Australia, Amit.
Yeah, good morning, Andrew. Good morning, everyone, and great to be back in Australia.
Pleasure to see you here again. It's nearly 12 months since the last pod you did for us, Amit. Clearly the world's changed a lot over the last 12 months. The macro environment has certainly been quite tumultuous. The markets have been quite volatile. So perhaps as a starting point, if we can just touch on what's going on, trade, tariffs, how you think those impacts are impacting the emerging markets and your investment landscape overall.
No, I think that's a great starting point. Yes, a lot has changed in the last 12 months, and I think market leadership has changed as well. So if you remember when I was here a year back, we did talk about there can be cyclical bounces and hope for China to recover from the kind of property market decline and consumption decline that we were seeing till middle of last year. We did talk about election, which was about to happen in India and what it can mean for India, which was a very strong market. We did talk about tech, which was very strong at that point in time. And I think a lot has changed in all these three very large parts of emerging markets. So if you talk about China, China went through a deep property down cycle, and it has been a very weak stock market, equity markets in 2022, 2023. We started to see some green shoots in 2024. But I think if you see now, fast forward 12 months, China has been the best performing emerging markets. I think on a 12-month basis, it's up about 40%. YTD, it is up about 20%. What we saw last year is that because China became too cheap, there was a bit of passive money going into China while active money was still going out. That caused a rally in some of the large caps in the index. So financials did very well. And then we saw a kind of big tech revolution that happened with the DeepSeek phenomena, which carried on this China market rally into this year. And it's largely driven by tech. But I think very importantly, what we see on a fundamental basis is stabilization of property market and consumption in China. And to me, that was a very important fundamental point for me to be even more optimistic on China. So if you see our fund today, we are about 8-9% overweight China. Our soft limit on any country overweight is about 10. So we are as overweight as we have ever been on China in our fund. And last year, it was more of a hope trade. I think I'm more convinced, driven by the fundamental data points that we see on property as well as consumption. So if you talk about property specifically, we have started to see stabilization in property sales, which went down by almost 50-60% in last 3 years. In last 5-6 months, month on month, property sales are recovering. Very small base, but still stabilizing and recovering. And very importantly, property prices are also stabilizing. Property prices went down 25-30%, depending on which tier cities we are talking about. And month on month, in tier 1, they are recovering 1% every month. In tier 2, they are stabilizing. I think this is very important part of the cyclical upturn in Chinese market. And that makes me even more bullish on China versus where I was 12 months back.
Okay, that's very interesting because clearly China has been a tough market. It has been a detractor for performance over the last couple of years, but you're now more overweight. We've seen that market rally, as you mentioned, but it has been quite a narrow market rally. So I guess just your thoughts on how that might broaden and how that would impact the holdings that you've got in the portfolio as well if we do get a broader rally.
So what happened in last 12 months is that while we were overweight China, and I expected this recovery to happen in China, as you rightly mentioned, the market rally has been very narrow. So while we were overweight China, China has still been a detractor in the fund and contributed to the underperformance, while we did well in markets like India and being cautious on tech. And this is largely driven by this China market rally being very narrow and driven by the top 10 stocks in the benchmark, which has been the case with, for example, NASDAQ or US in the last 3 years. That happened for China in last 12 months as well. So it is primarily financials, internet, and tech that has driven this last 12-month rally in China. We did have exposure to tech in form of Tencent, Meituan. We bought a couple of new names in last 6 months, but we didn't own financials. We didn't own some of the high-flying names like Xiaomi, BYD, and that has kind of meant that we have lagged the market recovery in China. But my belief is that China market rally will broaden from here. And we have started to see signs of that in March, where some of the internet names or tech names have been more flattish, while the consumer names have gone up 10-20%. This will be driven by fundamentals. And as I said earlier, we have started to see fundamentals improving. So my belief is that next 12 months, when we are sitting here, we should expect a broader China market rally. And that will mean that our large overweight on China in the fund should work well. The consumer stocks that we own, the broader economy stocks that we own, are relatively very cheap. The expectations on them are very benign. And I think if numbers moves up, and they don't need to move up like 20-30%. Consumption need to move up from 4-5 to 6-7. Property market stabilizing and just should move up low single digit, mid single digit. And then I think that can cause this market rally to broaden a lot, and some of these stocks can go up meaningfully higher from where they are. If you also see government actions in China, we saw an announcement of a big stimulus package in September, which caused a very strong, sharp market rally in last week of September, first week of October. But that kind of fizzled out because we never saw concrete, big stimulus package on the ground. Last week, Chinese government announced a coordination plan, which means that they want to tackle the structural issues, which is wage growth, unemployment, low quality supply, birth rate. And I think these are very important signs and policy pivot from the Chinese government that they want to drive this economy through consumption in next 3 to 5 years versus it being driven by infrastructure and manufacturing in last 3-5 years. So I think that's a very important policy pivot that we have seen, and kind of that makes me highly convinced that this rally should broaden from here.
Yeah, fantastic. It's certainly the question we get from clients is, when will the Chinese consumer start spending again? And it's great to hear that your confidence there, and also some of the green shoots that we are seeing appearing in China. Before we leave China, I guess it'd be remiss not to just dig into DeepSeek a little bit. And I guess, what does that mean for continued innovation that we're seeing out of China as well?
So Andrew, I'm a journalist, so I won't go into the granularity of technology here. But, there was a big question mark on China being uninvestable, falling behind on technology innovation, because when you see these technology restrictions of China not being able to access semiconductor chips, high-end chips from NVIDIA, some of the high-end technology equipments, this DeepSeek phenomenon tells you that China continues to be on a path of innovation and entrepreneurship. They have access to some chips, not all, but with this DeepSeek large language model, they have proven that they can kind of continue to innovate even with less resources. And I think that is very important for you to be, I won't say very bullish on China, but to be constructive on China. That this is a country which is the second largest economy in the world, second largest consumption pool or consumer pool in the world, but continuously innovating and moving forward with productivity as well. So now you see this DeepSeek model, which is an open source model, being used by everyone, all the companies that we can talk about, Alibaba, Tencent, Baidu, and all other tech companies in their respective areas. So Alibaba is talking about a cloud infrastructure play. Tencent is talking about large language model targeting advertisement and how to monetize it through B2C businesses. So I think this will further accelerate technology development in China. We have already seen this reflecting in a very sharp tech rally. All the internet names, all the semiconductor names have gone up a lot. We haven't bought them because I think it is very thematic. Returns get competed away in China. This is all open source. Everybody will use it. We will see great supply created in every sphere of technology. But I think this makes you more constructive on China on a medium longer term basis, that innovation is happening in that country.
Yeah, very much so. Yeah, now let's move across to the other big market in your universe. And of course, you're also managing the India fund. You're from India originally before, of course, moving to our Singapore office. But yeah, India's done pretty well, clearly, as a market until more recently. Valuations have been quite stretched. Economic conditions maybe have changed a little bit. So, yeah, observations across some of the challenges in India, but also some of the opportunities as well at present.
So if you see, when we spoke about China and the recovery and the cyclical bounce in China, India is kind of going exactly the opposite way. I mean, it's not by any design. It's merely a coincidence that India was one of the strongest emerging market in 2023 till first half of 2024. And we started to see, I would say, a cyclical economic downturn in India starting 2024, when all the major contributors of GDP started to slow down. Primarily government capex, which was very strong in COVID years and post-COVID years, they started to slow down. Consumption was sluggish. Private capex was sluggish. So GDP growth, which was around 7, started to be in a 5 to 6 kind of a range. India also went through a very large K-shaped recovery post-COVID, which was a global phenomena, but I think more stark in India, where the top 100 million people, and these are the people with assets, either real estate or equities, or they work for the government or large corporate, so their income growth was strong as well. They became richer, and they were consuming and they were buying stuff, while the middle class and the lower middle class was kind of not seeing the wage growth and the asset price inflation that would mean that they can consume a lot. So I think the government clearly recognizes that, and what we're gonna see now is I think a medium-term rebalance of the economy. So if you see the latest budget, the government has announced tax cuts for the middle class. We see more welfare schemes from state governments giving money to the lower middle class, which also means that given their limited budget, they're spending less on investments. So I think India is going through that mini cycle. We have started to see GDP slow down. We have started to see earnings downgrade across markets. So MSCI India has seen about 8-9% earning downgrade in last 6-9 months, and which meant that the market, which was very expensive versus its history, has started to derate. So India has gone down 20% from peak, 10% through earning downgrade, 10% through multiple downgrade. And I think that can continue in next 6 to 12 months. The fund was cautious on India. While we were overweight India, we were very defensively positioned in large banks, healthcare and IT services, which has helped the fund. So while India was overweight in the fund, India has been a positive contributor to performance in last 12 months. The overweight has also reduced, but I continue to remain bullish on India in long term. So you should see us going back, becoming more aggressive and higher overweight in India whenever I believe either the earning downgrade cycle has stabilized or valuations have become more reasonable for long-term investing. And that I believe can happen in next 6 to 12 months as we see this downturn, which is, I believe, a short-term downturn coming to an end.
Yeah, and just on the financials holdings, I know HDFC, ICICI Bank have been big holdings for you in the portfolio. Maybe just quickly touch on those names and also more broadly your view around financials, because it is a large part of your portfolio.
So the large part of our financials in India sits in these two banks, ICICI Bank and HDFC Bank. I believe they will remain very defensive in this current down cycle. They have already behaved very defensive. As I said, Indian market is down 20% from the peak, and these stocks have been flattish during that. So they have outperformed market significantly in this downturn. First, I think their earnings are very predictable in this downturn, while market earnings are going down. They are great underwriting franchises. They lend to the top 100 million customers that I talk about, which are in a very good shape. So they don't see bad assets at all in their balance sheet. And while their relative earning growth was lower versus market, in last 2-3 years, that is changing as market earning growth is coming down. So I think the relative earnings are improving. It is more predictable, and they continue to trade at discount to the market. At the start of this down cycle in markets, they were trading at 40% discount. Today they are trading at 25 discount, and I think that discount still narrows from here. So I think we remain highly invested in these two names. They should continue to behave defensive, and even when market stabilizes and goes up, I think they can keep pace with the market. So they seems to be very good investments to me today.
Yeah, fantastic.
And sorry, you talked about financials in general as well. The fund has overweight on financials. We talked about the Indian banks, but we have exposure to banks in Mexico, South Africa, Indonesia, and we own an exchange in Brazil. I think given all these banks or financials that we own are high growth financials, they are generally negatively correlated to rates. And what we saw in last 3-4 months, especially after the US elections, that there is this narrative of rates being longer for higher and inflation being more sticky. And that's generally negative for our financial exposure because we are generally in high growth financials who do not benefit from rate increase because they're already earning very high net interest margins, while they get negatively affected by increasing cost of capital. I believe my sense is that there's a lot of monetary room in emerging markets in terms of very high real rates today. And whenever Fed starts to cut, they can still cut rates. And that should be a good environment for our banks to outperform.
Interesting. And then if we shift across to Brazil, Latin America, I know you've got pretty strong opinions on the ability for strong absolute returns out of that part of the world from here. But just, touching on Brazil, interest rate environment's been a little bit different to other areas of the world. And how you're viewing that market and some of the holdings in Brazil as well.
So Brazil has been another tough market for us, as we spoke about China, where kind of the view on the market was right, but stock selection has been still negative. In Brazil, our view on market has been wrong in the last 12 months. So if you see at the start of 2024, interest rates in Brazil was about 11, and they were expected to go back to 9 through the year. Inflation was at 4-5, so real rates, which were 7 at the start of 2024, they were expected to go to 5-6, which is normal the case for Brazil. What happened is exactly opposite. Interest rate went from 11 to 13, and interest rate expectations went from 9 to 16. So at the end of 2024, interest rates expectations, which was 12-month forward interest rates in Brazil, was 16.5, with inflation being 5. So very high real rates. And in that environment, it's very tough for any business to work when rates are so high. And we own a couple of names in Brazil, exchange, which I talked about, called B3. And there is a car rental business called Localiza. And both of them are highly correlated or negatively correlated to rates. And they did underperform the Brazilian market. The FX also devalued, which means we had slight overweight on Brazil, which affected us negatively. But I think what the last 12 months taught me is that macro is highly unpredictable and not easy to forecast. But I think we are sitting at an extreme point in Brazil. I mean, I believe there is, in every large economy, there is a feedback loop, which means that if rates are so high, businesses are not able to work, consumers are not able to spend, that will mean the growth will slow down, spending will slow down, and that will mean that the rates and inflation comes down automatically. And I think that phenomena will happen in Brazil. And the couple of names that we own are very competitive businesses, and they are trading as cheap as they have ever traded in history, with rates as high as they have ever been in history. Yeah. So I believe the starting point in Brazil is very strong for an absolute upside and a large absolute upside in both these names. And that's why we kind of holding on to them.
Excellent. Thank you, Amit. Now, I guess as we speak, we've seen a big US market rotation and tech sell-off in the US. But looking across the emerging markets, it has been a more difficult market over the last 5 years, say, compared to developed markets. What is your bull case for emerging markets looking forward from here for our clients?
So, Andrew, if you look at emerging market returns, they have already started to improve. I think last 12 months have been high single-digit positive returns. This year, I mean, you have seen US market rolling over while emerging markets are positive. So we have already started to see that change happening. If you see where are the large absolute upside opportunities in the world globally, tech has already worked a lot. And I think we are kind of entering into probably a weaker demand and a large supply base of tech, which means that tech stocks could be weaker from here. But tech could still be long-term holdings given the growth dynamics that sits with tech. But in medium term, I think we're talking about demand plateauing. We're talking about high valuations in tech. US seems to be rolling over. US consumer is weakening at the margin. Valuations are still high. If you look at emerging markets, India, as we talked about, economy is slightly weaker than before. Valuations are still stretched. There are not many pockets of absolute return that you can see today. And in that context, I still believe parts of emerging markets, especially China and Latin America, are areas where I can see very strong risk reward and absolute return opportunities. China is about low 30s percentage of emerging market index. Brazil is about, or Brazil plus Mexico plus parts of Latin America is about another 8%. So that's about 40% of EM index. It's about more than 50 in our portfolio. And I think if you ask about our emerging market fund, I believe that is the part where I believe there exists a very strong absolute upside. And I can't say that for a lot of other asset classes globally. So I think if I have to put a constructive view of emerging markets, I think you still have a large chunk of emerging market which can provide absolute return. And we don't need dramatic changes in situation to arrive there because valuations are cheap, expectations are low, and fundamentals are improving. At the same time, I do see a lot of monetary room or monetary loosening room in emerging market, which is not the case for a lot of other markets. Real rates are very high. So I think if you combine all these things, I would say I never predict a kind of a return dynamics or how much return emerging markets can give from here. But your starting point seems to be very reasonable and there are lack of opportunities elsewhere. And we have already started to see that happening. So that makes me fairly constructive on emerging markets as we sit today.
Thank you, Amit. That's a great summary of where we sit across the market and also across your portfolio. Always great to see you in Australia. We've got a lot of meetings with clients this week and we appreciate your time on this pod today. So thank you very much.
Thanks, Andrew. Great talking to you.